Welcome back to Investing Talk Podcast.
Today we're looking at Broadcom.
As usual, before we start, subscribe, like, and comment to this video to support the show. If there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For you, we are dissecting Broadcom, a company that truly operates with a dual-engine growth strategy right now.
A dual engine.
Yeah, it's an unusual but really powerful combination. You've got this massive acceleration driven by AI growth on one side, and then highly durable, mission-critical infrastructure software on the other.
Okay, let's unpack this immediately. When we look at the recent financial performance, the numbers suggest explosive growth, particularly on the top line.
They do.
But is this high-quality, high-margin growth? What are the core numbers driving all this recent excitement?
Right. It starts with the sheer scale and, to your point, the margin profile. The latest reported quarterly revenue was $10.92 billion.
Wow.
That's a powerful 36% jump year over year. But you are right to ask about quality, because here's where it gets really interesting. The operating income was up 53%.
53.
That massive income leap pushed the operating margin to a company record high of 50.9%. So this is not just expanding revenue, it's extreme leverage. Every new dollar is highly profitable.
A 50% margin is just astonishing. Historically, semiconductor businesses can be, cyclical, capital intensive. 50% is rare air.
It is.
You mentioned the dual engines. Where is that specific profit power coming from right now?
That recent profit surge is almost entirely driven by the semiconductor segment. That segment alone saw a 44% year-over-year increase in revenue.
And that's all AI.
It's almost all AI chip demand. Specifically, we're talking about custom ASICs, application-specific integrated circuits that they design for the massive AI data centers.
We hear AI growth constantly. It's the narrative driving everything. But how do we know this isn't just fluffy guidance? Can you, quantify that demand in a real way?
We absolutely can. The figures show that Broadcom shipped approximately 20 million AI-related ASICs in the last reported quarter alone.
20 million units.
20 million. That is a staggering 120% jump year over year in physical units. They are translating demand directly into volume.
Because they're custom, they keep those high margins.
Exactly. That's the key.
Okay, so beyond the growth, how healthy is the underlying financial structure? Because that kind of growth often requires massive capital expenditure.
Their financial health is fortress-like, actually. Despite their history of big acquisitions, you have to look at their cash conversion. The company generated $5.92 billion in free cash flow in the quarter.
In one quarter?
One quarter. That gives them a free cash flow margin of 54.2%.
A 54% FCF margin. For a company this size, that is just incredible. That puts them among the absolute elite in tech.
It does. They're essentially printing cash.
Yeah.
And they are using it aggressively. They repurchased $5.1 billion in shares in just that one quarter.
That level of buyback shows huge confidence from the executive team in the current valuation.
Deep confidence.
So when we talk about AI infrastructure, competitive advantages are everything. We all know about NVIDIA's dominance, but what makes Broadcom so indispensable in its lane? What's their moat?
The primary moat is their vertical integration and all that proprietary IP. It creates enormous friction for customers who might want to switch.
Friction, how so?
Well, they're arguably the only semiconductor company that controls the full stack of plumbing used in modern AI data centers, besides the GPU itself.
The full stack of plumbing. That's a fantastic analogy. But what does that actually mean for the listener?
It means they supply the custom ASICs, the specialized brains, but they also supply all the complex networking hardware that allows those brains to talk to each other incredibly fast.
So not just the chips, but how they connect.
Right. High-speed Ethernet controllers, PCIe controllers, and critically, the Tomahawk switches.
Let's pause on those Tomahawk switches. Why are they so important?
The Tomahawk line is their proprietary switching chip. These are the critical bottlenecks in any AI cluster. They determine the speed of data transfer between thousands of GPUs.
So if the switches are slow, the whole system is slow.
The entire cluster grinds to a halt. Broadcom's Tomahawks are consistently at the cutting edge of speed and power, which gives them a huge architectural advantage.
So if a major customer, like a hyperscaler, designs their whole data center around Broadcom's ASICs and these Tomahawk switches, how hard is it for them to just rip it out and replace it?
That's the moat. The switching costs are massive. Replacing that foundational stack requires 18 to 24 months of a total re-architecture. testing, requalification. It's a nightmare.
2 years.
Yeah. That lag creates a near impenetrable barrier. It keeps their major customers locked in for years.
Okay, that's the hardware story. Indispensable. Let's pivot to that other engine you mentioned, the infrastructure software. How does that fit in?
The software segment, which now includes VMware, provides critical diversification and stability. It's their anti-cyclical buffer.
And how is that part of the business doing?
It grew 19% year over year. And critically, the net dollar retention rate is a very, very high 114%.
114%. That's a key metric. So customers aren't just staying, they're spending more every year.
Exactly. This is reliable annuity-like revenue. And management is laser-focused on leveraging those VMware synergies to expand margins there. It provides a revenue floor that most pure-play AI companies just don't have.
Okay, so let's shift to market reception. With these soaring margins and these huge AI numbers, is the street buying the story?
They are absolutely buying it. Analyst confidence is extremely high. Just look at the earnings revisions.
What are they saying?
EPS estimates for this year have been raised 8 times in the last 90 days. Out of 40 analysts covering the stock, a massive 34 rate it a strong buy.
34 out of 40. That's a rare consensus. What about insiders? Are the people running the company putting their money where their mouth is?
They are. The institutional accumulation has been strong, but what's really telling, what's fascinating, is that the CFO recently made his largest personal share purchase since 2020.
That speaks volumes. And insider buying at these elevated prices is a huge vote of confidence.
It's a significant statement.
And technically, what does the stock chart tell us? Is this just a momentum blip, or is there a sustained trend here?
The chart confirms the underlying strength. The stock just had a strong bullish breakout, trading decisively above that 1520 resistance level on really high volume.
And there was another signal recently, right? The golden cross.
That's right. For our listeners who may not follow technical analysis, the golden cross is when the shorter-term 50-day moving average crosses above the longer-term 200-day.
And why did that matter?
It signifies that intermediate momentum has surpassed the long-term trend. It's a classic signal that institutional money is accumulating for a longer growth cycle, not just a quick trade.
So momentum is strong, the institutions are in, and the fundamentals are accelerating. Looking forward, what should investors be watching for in the next few months?
There are 4 critical near-term catalysts to watch. The first is the Q1 earnings release, which should be around April 29th.
And the key thing to watch there will be AI revenue.
The rate of acceleration in AI, yes, and management's updated guidance for the rest of the year. Whisper numbers are already expecting a guidance raise.
Okay, what's next?
The Investor Day on May 15th. This one is massive. The company is expected to unveil its detailed AI ASIC roadmap all the way through 2028.
So that gives long-term visibility.
Exactly. Then you have the OFC conference in June. Broadcom is set to demo its 1.6T Ethernet switching chip there, which is expected to be an industry first.
Always staying ahead on the networking side.
Right. And the fourth catalyst, which actually just happened, but we'll see the impact soon, was the acquisition of Velis Technologies in March.
What do they do?
It's a strategic move to boost their generative AI model optimization software. So they're not just selling the plumbing, they're selling tools to help you run your models better on that plumbing.
Fascinating. We've covered the bull case pretty exhaustively, so we have to be balanced. Where's the risk? What's the bear case that could derail this?
You're right. While the outlook is strong, there are 2 primary risks: customer concentration and the current valuation.
Let's start with concentration. How exposed are they to just a few big players?
Customer concentration is high. This is the most immediate risk. The top 5 customers, your big hyperscalers like Microsoft, Amazon, Meta, Google, they account for 42% of total revenue.
42% from 5 customers. So if even one of them slows down their AI spending.
The ASIC business will feel that impact immediately and sharply.
Okay, that's a real risk. What about the valuation side of things?
Well, the second risk is the valuation itself. The stock currently trades at roughly 43 times forward earnings.
And to put that into perspective, its historical average is closer to, what, 17 times? So that 43 times multiple is pricing in a lot of growth.
A lot of growth and flawless execution. It moves it into that high-growth software valuation territory. It means the stock is exposed.
Yeah.
Any slight miss on guidance could lead to significant volatility.
But that's where the software diversification comes in, right? That sticky revenue helps mitigate the pure AI hardware risk.
Absolutely. The sticky, high EBITDA software segment acts as that non-cyclical buffer. The AI business drives the excitement, but the software provides the deep operational resilience and the cash flow floor.
So to summarize the full picture for you, we have this high-growth, high-margin, indispensable player in critical AI infrastructure. An unshakable tech moat, powerful cash flow, strong momentum.
But
But it carries elevated valuation expectations and a very real customer concentration risk.
right. What stands out to me as the ultimate takeaway is just the unique combination they have. They are one of the few names positioned to structurally rival the custom AI chip leaders, all while sitting on this expanding annuity-like software revenue stream.
And the structural question for you, the listener, to mull over is this. Can they leverage that massive installed base of enterprise software customers to embed AI tools directly into existing infrastructure? If they can turn their software arm into an accelerator for their hardware sales, that's the real long-term story.
Fascinating analysis. Thank you.
Don't forget to subscribe, like, and comment to stay up to date with our latest analysis.